Hi, this is Ron Janish, and in this particular presentation, we're going to take a look at what occurred in the past, and this is going to be done in order to give you an idea as to what kind of technology is being used in the software, and another purpose here is to achieve an idea as to quality of the technology that is put in the software, but also to uh, show you what else is needed in the software in order to get the results on the scale that we're looking at. So we're going to have a discussion later on as to why the computer software is actually needed in order to do this on the large scale that is being proposed. And what we're going to do is we're going to show you some buy and sell signals historically, and we're going to limit ourselves to ones that were time-stamped by CNN. So we're not just going to take any ones that happen to have occurred in the past in a simulated mode, but ones that were presented on CNN and timestamped by them. Okay, so this one, this particular signal here was timestamped on CNN on July 8th, 2014. I'm sorry, January 8th, 2014. And basically it's a buy signal in the hogs, and we posted it right here. Okay, and then prices came up and came a tad lower over here, and then finally took their dramatic upswing. Now, this is in something called the hogs contract, and in this particular contract, the profit is over 1.0 for every penny it goes up here. So from over $500 for every time it goes from 105 to 106 to 107, et cetera, et cetera. And the margin that an investor is required to put up in order to have that kind of a benefit is somewhere under $1,000. And in futures contracts, there is considerable theoretical risk, which one should familiarize themselves with before ever getting involved in this kind of thing. But this was posted on January 8th, 2014. Let's take a look. And this is the exact chart that was posted on that date. It'll take a moment for this all to go in there, and we'll be able to see what exactly the date was and see from a third party. Here we go. Posted January 8th, 2014, like I said. And so let's go back to the other site, and this will take a moment. For some reason, my computer is tied up with a bunch of things today. So anyway, this was posted on January 8th, 2014 on CNN. That's the exact record that we have. And this is one of the things that we would be looking at in terms of what would be having in the portfolios. Take gold, for example. At the end of the year, there was a signal over here using the technology that we use. And on January 1st, we posted a weekly chart on CNN, which looks very different than this. And because this here is a daily chart. And as you can see, the price here, down here, it says 115 or 116. And up here, it's went up to 130 something. Let's take a look at what was posted on CNN. Now remember, this was posted on January 1, which is approximately over here somewhere. And this was a weekly chart that was posted originally. And one of these servers is kind of slow. There we go. Okay, and so we can see here what was posted back January 1st on CNN. And prices were down here at 116 before they rose up to this level here. Okay. And so the alert for that we communicated to buy this particular one, which we did take a position in, was communicated back on January 1st. And we're going to take a moment here and go back. There we are. Okay. Now let's take a look here. Now, in addition to using advanced Andrews-Babson technology for commodities, it is used for determining buy and sell points in bonds. So back on January 8th, 2014, we posted a chart which did not have this nice down move here. Instead, it was before this down move occurred, and at that time we were considering the idea that prices had a good chance of popping this magic level, which was the 4.0 level. And sure enough, they didn't. They broke down here, giving us a sell signal in interest rates, or down signal in interest rates, which resulted in a buy signal in the bonds. And this is when we posted on January 8th, 2014. And as you can see what happened after that. And if you wanted to go and see that chart, you just go click on here and you'd see that chart. Okay, let's see. Now, on March 7th, 2014, we posted a chart on the Dow Jones Industrial Average, suggesting that this here was a high. And yes, it was a high. It was accurate. And as you can see, on this 15-minute chart, prices spent a considerable period of time going down here for the next, several weeks. And let's take a quick look on here if we can find this chart. No, it's not on here. Anyway, not a big deal. It's on the CNN site. So basically what we did was we posted it on showing that this was a perfect pattern and had a good shot of being a very significant high. And the advantage of being able to go into this kind of granularity, this kind of small size, is that one is then able to trade a much smaller size. But to trade on a smaller scale, like this kind of 15-minute chart, one would need some software that would do this automatically, because it's very taxing for one person to do all this kind of thing in terms of all the buys and the sells, and unless one is totally dedicated to that. Now, this technology that we're using, the advanced Andrews-Babson technology, also is applied to stocks. And above here is the gas company that was posted on CNN, when prices were over here, it was posted that this was very likely to be a very good reversal point. And as you can see with perfect 2020 hindsight, now that this time has passed, is that prices did come down and test these lows and now has gone up considerably. Let's take a look. There we go. This is the same stock, and this is what we were looking at right at that point in time. And if we just wait a minute and just come down, it takes too long. The heck with it. Press the back button and we'll get back. And the reason it takes longer on my computer for others is because of some of the features I have, which includes the mile finder feature. So in other words, whenever I go to certain sites, I get airline miles, which is kind of interesting. Now, recently there was a post on CNN, with a chart that went up to about over here. By clicking over here, you can find it. That suggested that Google was going down, and it did go up a little bit more for a few days. These are daily bars, and then it did finally go down. That this area here was a very significant topping area. Now it's it's well known that past performance can never guarantee future performance of any system, no matter how incredible it is. And the reason we need to put this technology into software is so that we can work different time frames automatically at the highest possible level in terms of competence. And the other one is scalability, and to help you understand the analogy of a franchise that serves food is going to be used for this. For example, if one is to prepare a single meal, excuse me, for 5 or 10 people, one simply goes to the store and purchases what is needed. If the same meal is prepared for 1,000 people in a fast food franchise on a daily basis, an incredibly reliable vendor that can deliver products on a regular basis needs to be found, and contracts need to be signed in order to ensure this reliability from that vendor. If several franchises purchase the same food in a set geographical area, even greater arrangements need to be made in order to ensure proper supplies are available. And McDonald's even locks in certain prices by locking in those prices in the futures market. So when it comes to investing, supply is very limited at a reasonable price that would justify the investment and the risk involved, and that amount of supply that is available varies with the investment. So, for example, in the futures market, there is greater supply available in the stock market indices than there and the treasury bonds than there is what supply available in the gold futures. And the supply available in gold futures is much, much greater than the supply available in hogs. So even someone like McDonald's, for example, needs to be very careful when they buy hog futures or cattle futures and guarantee a certain price in the future on those things. And they need to be very careful going in because if they go in a massive fashion, all of a sudden it makes prices go wild and spike. So they need to gradually go in there in terms of price at a level that's appropriate for them. Now, if one is to trade under $1 million or multiple accounts with a total of under $20 million, let's say, it's easy to make a quick decision as to how much is appropriate to trade in the different investments discussed here. However, if one is to work with larger amounts, it is important to have a simulator of some sort with computers rather than doing it manually in order to understand where to trade the much smaller amounts and how to do that. When it comes to simulating what may occur, we like to use something called real-time simulation. When you only use historical simulation, it's kind of like a lumber yard. You can build whatever you want with it, but it doesn't mean it's real. So, for example, one of the things we did recently, we started up a simulation of what might happen with a $100,000 account. And we did this using a service provided on the web rather than just, putting it on our machine. And we downloaded it today, and this is kind of a picture of the results we had. We started, several weeks ago, as you can see, because we're now at the end of March, and we started near the beginning of March, and sure, it starts out at 100 and goes down to 99, and now has gone up a bit to somewhere around 100 and close to 103,000 in this period of time. And you can see the ups and downs. This isn't only just ups, but there's downs also because there's fluctuations in the market. And these were some of the actual positions that were in this simulated account. And the simulated account, by the way, is still active. So this is a real-time simulation of $100,000 in a simulated account trading stocks. And the stock selection and trade size would be very different if it was a $10 million or a $100 million account. And that's because in many of these stocks, one can't do a massive position size. One would have to come into the trade in a very small fashion, and putting a stop in can't be done. So this is why it is absolutely vital to have excellent software for testing, simulating, and controlling things. So I thank you for your time and hope you enjoyed the quick presentation.